No more car loans. That's right. Banks are literally tightening up the purse strings. So if you're a Gen Z, if you're a millennial, good luck. Banks are likely not going to lend because traditionally and statistically, they're more likely to default on some of their car loans. Now, there's a lot of statistics showing that a lot of banks are tightening up. They don't want to lend money anymore for cars because delinquencies are on the rise in a gross way. What we've been finding recently is household incomes typically less than $45,000 are the biggest at risks. They're generally the hardest to come by extra money, and as a result, we're seeing a lot more delinquencies, not just on car loans, house, mortgages, as well as even credit card debt seems to be on the rise, and delinquencies are literally out of control. And again, if you're sub $45,000 income, going down to the bank and getting money to buy your next car, new or used, could result in a real complicated affair. A lot of banks just don't want to lend you the money. Getting a car loan is an ever-challenging feat. Austin Goolsbee of the Chicago Federal Reserve Bank president actually said consumer delinquencies were one of the most concerning economic data points at the moment. If delinquency rates start to rise, that is often a leading indicator that things are about to get much worse. Generally, what we're noticing is first-time and low-income buyers are generally the ones that are biggest at risk, and statistically showing that they can't necessarily continue on making their payments, largely because they don't have as much money to put in, they have less cash flow, and as well, even to get into a moderate vehicle, their monthly payments for their new or used vehicle are usually outside of what they can truly afford. Remember, we talked about this. You should never exceed 50% of your annual income on a car value, and you should definitely never exceed 10% of your gross monthly income from your job. So in the first quarter of this year, the Bank of America actually saw significant rises in net charge-offs. Charge-offs, that's basically the debts that they're not able to recuperate. So last year, this time, it was about $800 million. This year, we're up to about $1.5 billion. Very concerning, as a lot of people are defaulting and the banks are left holding the bag. So of course they're puckering up and they don't want to lend out to just everybody. And one of the rivals, JP Morgan Chase, actually went up to almost $2 billion in the same time frame, showing that the consumers of the lower household incomes generally are struggling and the cost of living crisis is real. And it's showing in real ways of the fact that they're defaulting and delinquencies are up and they can't make their car payments. Next, of course, they're making choices to eat or not to eat, medication or no medication, maybe even rent. Some of them are defaulting, can't pay certain utilities for their house. Things are getting tight and it's very difficult for a lot of people making these decisions. So at the end of the day, it's living in a house or car payment. Well, if you can't have both, which one gets to go? Car payments, gone. The Bank of America is seeing cracks in the finances of a lot of people that are generally subprime. People that are hovering on the line of affordability. And as you go up the range, you find people that have more higher levels of annual income. For example, that $100,000, $150,000, $200,000 annual salaries are having less time and are able to sail through this. But suffice it to say, banks are getting nervous, and because of all the mass increase in delinquencies and defaults, they're much more inclined or far less inclined to actually give loans out to everybody. So banks like Capital One, Old National Bank, and First Mortgage Direct are some of the key ingredients or some of the key lenders that are okay with lending to high-risk buyers, 300 to 600 credit scores, which generally are considered subprime borrowers, and they're okay lending there, but that comes at a cost. Of course, those subprime borrowers are often borrowing at rates of 12, 14, 20%. I've even seen as high as 22 and above percent interest rates for people that are subprime. And those are the banks that are willing to take the risk because the payoff is huge. Now, nobody wants to see anybody default, but there's still that balance there, that balancing teeter-totter effect of, maximizing the income and still taking that risk, of course, lending to somebody that may default on their car loan. But there are banks out there still willing to lend to those high-risk borrowers. According to a quarterly survey, loan officers polled separately were actually responding by the Federal Reserve saying that they were tightening up lending standards, which include credit cards and auto loans. And a significant number of those banks actually suggested that the standards were going to rise even much more aggressively on credit cards because that's where people often default. They can't make their car loan, they somehow steal from Peter to pay Paul, and they take from their credit cards and they pay off other debts, and they're good at cash manipulation through credit. But at the end of the day, you can't get blood from a stone. If people don't have it, they don't have it. And meanwhile, unfortunately, what we're seeing is the Federal Reserves and the banks of both US, Canada, and beyond are not actually cutting interest rates. As much as everybody feels the burn and the crisis, the cost of living crisis is real, a lot of people are struggling to make their car payments, their credit card payments, their house payments, their mortgages, and yet the banks are seeing stimulus. They're seeing new job creations. They're seeing people actually still buying. And obviously, inflation is still high. If inflation's still high, the trigger has not been activated to actually reduce the interest rate. So the reserves and the banks aren't necessarily activating that. And we don't actually expect to see interest rates to drop until at least September of this year. So while people typically of the higher income levels are doing fine, they're still somehow skating through all this, although they have less money to do those things they want to do. Less steak nights out, less holidays to the Caribbean, less new vehicles in their fleet, but they're generally getting by. The people really impacted are the Generation Z, millennials, and of course the 300 to 600 credit score folks. So, and lower income levels are generally all going to be a major impact on the fact that we're seeing delinquencies actually on the rise and people struggling to make their car and credit card loan payments. And in all of this, we're seeing US household debt surging to an astronomical level we've yet to see. We've actually tapped $1 trillion. Yeah, you're basically credit card debt and how that's getting racked up. People are having to spend a lot more on credit cards to pay for food and even to top up for car loans. People are spending on a lot of need to haves, not even so much want to haves. Credit scores were artificially inflated with increased savings and lowering spending. Credit card delinquencies are a key indicator to watch because they are a representation of people living beyond their means. Americans managed to save about 3.6% in February of disposable income, which is actually down from 4.7%. So literally people are tapped, they're running right to the limit, red line on their savings constantly, and it's getting worse. Overall consumer delinquency stood at about 0.98% here in February across loan categories such as mortgages, auto loans, and credit cards. Sadly, that's been an increase over the last several months. And according to data indicated, consumers with lower income levels, 45,000 and less, had a much greater financial stress this year. And the group of those US borrowers with high credit scores is actually shrinking. So in other words, much fewer people who actually have the ability to buy at prime rates and are able to easily afford those car payments and those mortgage payments and their credit card payments, that number is shrinking dramatically. In other words, the haves and the have-nots are closing in and it's all becoming the have-nots. And with all of that said, right there, check out that car buying crisis is alive and well. What's going on? We know this. People are struggling to make their payments and it's a real cost of living crisis. Hope to see each and every one of you on the next one. We'll see you real soon. Bye-bye.